Hey folks, it's time to talk about depreciation. So we've got some new terminology in this class or in this lesson, in this chapter. So let's talk about the definitions a little bit before we get into the problems. Okay, depreciation is defined as allocating the cost of a long-term asset over its useful life. So what we're doing is we are taking assets like property, plant, and equipment, which would be your buildings and your equipment and any machinery you have, and maybe some office furniture or office equipment, whatever. And we're going to use it over several years. So what we want to do is we want to match the cost of the asset, the cost of using it, with any revenue it helps us generate every year. So we do that with the depreciation. So as we use an asset each year, we write off a little bit of its cost each year to the income statement, so that at the end of the asset's life, most of that cost has been written off as we've used it. So it's matched the expense with the revenue it helped generate. That's the plan. So it's a cost allocation method. Depreciable cost is the total. Okay, let's go back to this one more time. You remember when we talked about adjusting entries and we did a prepaid expense? And depreciation was an example of that prepaid expense. That's exactly what we're doing here. Is we are buying an asset, we're prepaying for it, and we're going to write it off, use an adjusting entry to write off that asset a little bit at a time over its useful life. Kind of like we buy a 12-month insurance policy and we write off 1 month of insurance expense every month for the year until it's gone. Same thing with depreciation, except it's over years instead of just months. Okay, that might work better. All right, depreciable cost is the total cost of a long-term asset minus the salvage value. It's important because depreciable cost is the maximum amount of the cost that can be depreciated, and it will also equal the total depreciation expense for the asset. So you've got some check figures right there built in to know if you've calculated your depreciation correctly. Another very important term is book value, which is the cost of the asset minus any accumulated depreciation for the same asset. It may also be referred to as net book value. So let me skip down for just a minute and go to the balance sheet presentation here. This piece is extremely important, and you must understand how it shows up on the balance sheet. So what we're going to do is you're going to take you're going to be on the balance sheet. In a classified balance sheet, you've got current assets and then maybe some investments and then property, plant, and equipment. So we're in that property, plant, and equipment section of the classified balance sheet. So we're going to put the asset on at cost, and we'll label the asset, whether it's building, machine, vehicles, equipment, whatever it happens to be. And we're going to make sure we label it that this is what it cost us. We also have to put on the face of the balance sheet the accumulated depreciation for each asset. And then we subtract them, and the difference is our asset at its book value or net book value. They mean the same thing. So FASB, which is our rule-making authority, tells us the cost of the asset has to be on the face of the balance sheet, along with the accumulated depreciation, and the net book value then is what is added into the current assets and other assets and to come up with total assets. So make sure you understand where and how it all shows up on the balance sheet. Okay, so salvage value, depreciable cost, remember, was cost minus salvage value. So salvage value is the amount of money that a company thinks it can probably sell that fully used asset for at the end of its useful life. It's not a whole lot of money, but it might be, it depends on the asset, how much it is. Another term for salvage value is residual value. The final definition is accumulated depreciation, and that is the total depreciation expense that's been taken on an asset since the beginning of its useful life. Okay, so the journal entry that we make is going to be a debit to depreciation expense and a credit to accumulated depreciation. So what's happening is the depreciation expense goes to the income statement. It's a temporary account. It gets closed out at the end of the asset's life. The accumulated depreciation is a permanent account on the balance sheet. Remember, we just talked about it being on the face of the balance sheet. So that's a permanent account that never ever gets closed until you sell the asset. And then when the asset's cost goes away, that accumulated depreciation will also go away. So if you want to keep a T account as we're doing the other videos, you're quite welcome to do that to show that what we're putting in accumulated depreciation simply accumulates every year to come up with a bigger and bigger balance. There's one more thing I didn't put in this little piece, but we're going to talk about in the other videos, is that you cannot depreciate below salvage value. I should probably put that right there, and then it'll be there and you'll have it. Maybe I can put it in there. Alright, cannot depreciate below salvage value. Okay, that's important. So you guys need to remember that. Okay, so what I'm going to do is I'm going to take 3 depreciation methods that we're covering in this chapter, and I'm going to do a video over each one separately so that they're not too long and you don't have to lose your attention span too fast. So the 3 methods are going to be straight line, units of output, double declining balance. And I'm going to use the same basic information for every example, and I'll review it again. We're going to pretend that a company purchases a new very fancy copier. The cost is $100,000. Its salvage value is $10,000, and it's going to last either 5 years or 20 million copies, whichever comes first. I guess I didn't need the word million in there, did I? Because it is 20 million copies. Okay, that's it for this one, and I'll see you in a minute with straight line depreciation. Thanks. So they analyzed each accounts receivable, and they placed it into a category based on when the account was created. So you can see that we have the ones that are current, which are less than 30 days old. We have ones that are up to 2 months old, 3 months old, and over 3 months old. After researching some past bad debts, percentages of the bad debt were associated with each category based on the age of the receivables. So if you'll notice, the most current receivables we expect to receive the most money. As each accounts receivable ages, less and less of it we expect to collect, or more and more becomes uncollectible, whichever way you want to say it. Okay, if we multiply the accounts receivable in a particular category times the percent for that category, then we can come up with an estimate of how much of the total in that category we think will be uncollectible. So we'll do the multiplication out and add up everything that we think we cannot collect, and that will be, for rule number 1, the number that we compute. Okay, so rule number 1, take a percent of a balance sheet number. So we took different percentages of all balance sheet numbers, and based on that aging analysis we came up with excuse me, we think $19,500 will be the bad debt, will be the amount of uncollectible accounts. So that number we computed is the required credit balance right here in our T account. So put in the previous balance, put in what you want it to be, and then compute the formula for what you need in your journal entry, which is the difference of $17,500. So we're going to debit bad debt expense for $17,500, and we're going to credit allowance for bad debts for 17.5. Okay, so that's pretty much a really short example and sample of accounting for bad debt expense in with the accounts receivable account. I hope you learned something. Okay, we'll talk later. Bye.